This whole webinar came about mostly because I get asked the question all the time, how do you guys suss out these properties? How do you find them? How and underwrite them? And what's the whole process you go through before you kind of sign on the dotted line? So I kind of floated the idea with Mariana, our marketing gal, and this is what we came up with. So I guess I should just bid a good evening to everybody, and thank you guys a lot for joining us. Ryan and I are genuinely excited to have you with us tonight, and we believe this is one of the most important conversations an investor in multifamily can have in today's market. Before we get started, we're each going to kind of take a minute and introduce ourselves and share a little bit about our backgrounds. But I'm also delighted to welcome our friend and strategic partner, Eric Strom of Iron Ridge Capital. Eric brings more than 2 decades of multifamily operating experience, and he's just a real good guy. So after our introductions, we're going to focus on 3 principles that have guided me throughout 50 years of investment. And that is structure matters, operator selection matters, and disciplined decision-making matters. So markets change, interest rates change, real estate cycles my favorite word that I like to use around multifamily, but those principles don't. So our hope is that you'll leave tonight with a practical framework you can use to evaluate any multifamily investment, whether it's with Porter Legacy Group, Iron Ridge Capital, or another sponsor. With that, let's begin with a brief introduction, and we can go with Ryan first.
Yeah. Do you want to move the slide along? I think.
Oh yeah, that's probably a good idea.
So yeah, my name is Ryan Porter, and I am a co-founder of this small team that we call Porter Legacy Group, and I have a long history of experience in the technology field, based in the San Francisco Bay Area. Working with consulting on technology in the Bay Area, and so over time I've gotten highly interested and invested in real estate, and I started basically on the single family side in the Bay Area and also in Latin America, buying condominiums and gutting them and flipping them, and or holding them as midterm rentals for a period of time. And so I did that for a period of about 10 years. And I really wanted to scale that business. And so I came upon multifamily a number of years ago, started traveling to Dallas, started going to mentorship groups. And here we are a few years later with some experience under our belt, especially with our partners, Iron Ridge, that my father just mentioned. And so I've been focused more on the acquisition side of things, underwriting, trying to understand risk, and I just kind of bring the technical and the process side of things, operational side of things. And my dad has kind of been focused more on the capital raising and the money side of things. So I'll stop there and let you introduce yourself, Dad.
It's Eric's turn.
Okay.
Oh yeah, I'll go. I've been in commercial real estate, particularly multifamily, for 26 years. Started as a broker in 2000, and I put about 9 years into that before we hit the Great Recession. Before the Great Recession, I'd invested in several projects on my own, relatively small stuff, and started syndicating 2007, 2008, and just learned a lot of lessons, from a young guy that, was partnering with, experienced folks that knew what they were doing. Kind of went from the guy that thought you had to be the smartest guy in the room to realizing that everything in this business is about relationships. And it's been a really wonderful thing to have a great relationship with Ryan and Bruce, and they've been great partners on several deals. And our approach has always been just be very disciplined, do what we say we're going to do. We've done 19 projects over 19 years. Give you a kind of an idea that we're not deal junkies. We just try to find the right ones and put our money next to our investors' money and just do the right thing. So I never lost any money, never had any capital calls. I mean, as that says, we've had an average return of 23% a year. That's over a couple cycles. Incredibly proud of that. And it's just showing up every day and working hard and being relentless in the approach.
Awesome. Thank you. So, because I'm the older guy here, my story is long, so I'm going to spare you a lot of the details. But many of you might wonder why someone would start a new business at age 75. But after spending 14 years in real estate early in my career and 36 years on Wall Street, raising private equity, the answer is simple. I just wanted to build something meaningful with my son, and real estate's always been part of our family story. It's literally in my DNA, and together we've combined my 50 years of investment experience with Ryan's technology background to build a firm focused on one objective, and that's helping investors preserve capital while building long-term wealth through disciplined multifamily investing. I love this asset class, and I'm extremely passionate about it. And so far, our clients have shared my passion, so we hope that continues. In any event, let's get this show on the road. So now I have to keep remembering to move these slides. Here's what we're going to cover. Why some multifamily deals are struggling today, and what many investors misunderstand about this cycle. Again, my favorite word. How multifamily investing actually works, a framework for evaluating risk, a real world case study, and how we all approach investing. There's just, again, I'll bring up the word cycle again. I'm here because Ryan kind of shared his thoughts about the whole market. And I looked at it and I saw that if we did want to join, now would be the time. And mostly because others set us up for it with, a tremendous amount of easily accessible floating rate debt risk back in 21, 22, whatever, and maybe even 20, 21, 22. Totally aggressive underwriting, somewhat reminiscent of the 08 retail thing that went on, and over leveraged capital structures, and because everybody was jumping on the bandwagon, a lot of operational weakness. So it's a separation between durable investments and fragile investments. We hope we're building durable investments, and we're focused on preserving cash flow, managing downside risk, and positioning for long-term recovery. We're not saying there's not risk. We're just buying them out and outlining them and figuring out a way to deal with them, prepare for them. So what many investors are missing about this cycle. So there's on the left side is, again, why we're here. There was a tremendous amount of overbuilding, historic amounts of supply, and aggressive underwriting. We already mentioned the use of floating rate debt and other really, shall we say, aggressive debt instruments. And so that's created a huge kind of supply surge. Well, if you know anything about construction and new starts and development, you know that the leading indicator is permits, and the permits are down significantly, 35% at the time we did this slide, and they might even be, they're probably down more. You've got the influx of people into DFW, an area where we're 100% focusing on, and the elevated supply caused the short-term rent softness, but it appears to be easing. And the demographics and jobs and affordability continue to drive renter demand. And I would invite either one of you guys either to talk about the gold side or the green side, because this is kind of a pretty telling slide.
Yeah, I'll hop in on that. First of all, I love the data points here because I mean, when it comes down to it, everything really is supply and demand. And if you rewind about 8 years ago, we had built up, over about a decade and a half portfolio in Washington State, and we were trying to figure out, okay, well, where are we going to go and where are we going to spend the next 30 years of our career? Because it was getting a little bit overregulated, and we just couldn't get the same return metrics that we were used to. And so when we looked at DFW at the time, they had about 700,000 units, and you can build very aggressively in Texas because you've got flat, dry, and rectangular land. It's a very easy place to do business. And so you had this almost perfect storm of late cycle real estate activity where you still had very cheap debt. You could build a lot. You did have a lot of people coming in, and we've still seen a lot of that absorption. But the big one on there, when you're looking at floating rate debt and rising interest rates, I would say that the majority of stuff purchased, somewhere between 2020 and 2023, this was all done on floating rate bridge loans. And so when they took those loans out, it was at about 4%. And when rates went up 500 basis points, they went up to about 9%. So you doubled your mortgage payment every single month. So when Bruce is talking about cycles, you have basically doubled your primary expense, and you have a lot of people in trouble. So this has created an incredible opportunity where rates have gone up, so values have gone down, and you have a lot of pain in the market. So we're in that very special place right now in a real estate cycle where we're not yet into the first inning of the next cycle, but we're flushing out a lot of, I wouldn't even call them bad decisions. I would just call them people that didn't have a great crystal ball on where rates and supply were going to go. And there's a lot of pain that needs to work its way through the market. So consequently, we have, incredible opportunities where I think that some of the pricing that we're going to see on these assets, I don't think we're going to see those prices again anytime in the next, 6, 7 years. So if you know how to identify a great property that has all the characteristics that Ryan and Bruce are talking about in terms of, durable underwriting, and you've got good runway and the fundamentals of the investment work, there's a real opportunity on basis.
Excellent. Thank you. Thank you so much. The mechanics of multifamily. Well, we acquire a cash flowing community and optimize operations. That's why it's nice to have someone like Iron Ridge with a vertical integrated management, and increasing NOI mathematically increases the property value. So cash flow, appreciation, and tax advantage depreciation really warms the cockles of my heart, that last one, because I've placed just about every asset class there is in many high net worth clients' accounts, and I didn't always have all three of them together: cash flow, appreciation, and significant tax advantages. So it's a good one. And this is just a comparison for people out there that, like Ryan and I, and probably Eric as well, who have gone the single family route and still have single family properties in our portfolios, but it's just, kind of simple math. Vacancy in a 100 unit asset is one vacancy in a 100 unit asset is 1%. And a duplex is 50%. And you can't get the high quality staff. So you're the one that's running the single families. You can't afford them. So the apartment complex, you're buying wholesale, usually better than buying retail. And okay, so the bottom is the ceiling versus the floor. Chasing the highest projected IRR is what people were doing, and there was just a lot of talk about it. And it's important, but it's definitely not everything. You're going to see that this particular reference a couple more times in the slides. And the solution is, like I said, recognizing the risk and prioritizing the downside protection. What's going to go wrong, and how are we going to fix it if it does? Anybody? Oh, we're good.
I think that's a lesson that a lot of people would have liked to have had over the last 3-4 years. Because, I mean, the reality is that, if you want to on a spreadsheet, you can make any investment work. And one of the things I've really appreciated, working with Bruce and Ryan, is that we're always modeling what can go wrong. And if something does go wrong, can we withstand it? Because I think it's not really a question of if, but it's a question of when in any real estate cycle that you're going to have some headwinds. And the more important part is, price and underwriting can be relatively forgiving, timing cannot. So, that there's always going to be a downturn. Can you weather your way through it? And have you given yourself enough runway to get through any type of down period and be conservative about what you do?
Well said. Definitely. What many investors get wrong. Ryan, you want to take this? Is Ryan there?
Yeah, I am here. I think, this has been talked about a little bit, right? But, the mistake in the top, chasing the highest projected IRR, we just talked about this speculation over durability, folks pricing in rent increases that are not necessarily there, or haven't been there recently, and are relatively flat right now. And I think in Eric's portfolio, they're seeing extensive rent softness, and even rents going down in some places. And so that durability is definitely key. We've talked about the risk that's kind of associated with multifamily versus kind of single family. When you have larger assets, 100 plus doors, there's inherently some safety in that. And a lot of our folks that we're talking to are coming in not knowing multifamily and or having invested, in single family. And so one of the reasons why we love this asset class is just this idea that we're getting into buildings and we're spreading that risk out over, a number of doors. And so, the approach here, the better approach is just, what we see in the bottom there is just downside protection. Eric, in our underwriting sessions with him, is kind of emphasized, well, how does this model look if rents go down 5% or 10%? And so, just making sure that we're modeling and looking at worst case scenarios, scalable operations, having diversified income streams within these assets. So it's not just rent coming in; it is parking, it is other rubs, other streams that are coming in with these assets. And so I think the key point here is just structuring these deals correctly, whereby we're looking at various variables in the models, and making sure that we're looking at what can go wrong. And a lot of times, basis, an incredible basis cures all ills. And so if we can pick these assets up at 20-30% below what they were at 4 or 5 years ago, and we're doing the modeling that we've just talked about, we feel like our downside is really, really protected. So I'll stop there.
Excellent. Excellent. Great. Thank you. There's the basis right there on this slide. On the first panel over there, a simple framework for evaluation. Basis: buying below replacement costs, buying below comps, buying below the neighbors. And then, I personally used to believe that basis was absolutely everything, as Ryan just said, and it really still is. But now, maybe after seeing what happened in 2020 through 23, debt structure is equally important. And then yield over speculation, day one cash flow, very, very important. And durability is probably one of the most important things that you want to think about. How does it fare and function through the potential of problems? And okay, so structure.
We had a question, Bruce, that I think that you're uniquely qualified to answer. How does multifamily fit into a diversified investment portfolio?
Well, I don't want to answer that until the end. But I didn't even say why didn't I see the question? Well, it fits into the tune of at least 25%. Period. You should have that much of this asset class in there, and you could even go higher, because, as I said before, okay, you got the bonds and you got the stocks and you got the mutual funds and you got maybe annuities or some sort of estate planning insurance or whatever. But this asset class gives you cash flow, monthly or quarterly distributions. And if you're a very conservative underwriter or operator, as Strom is, you're probably not going to get that until a year down the road, because he just wants to keep everything really healthy until it makes sense to distribute them. But they're going to come. And then you got capital appreciation. I mean, in most cases, just improving the rent, thereby improving the NOI, is going to drive the the capital appreciation. But if you add to that, one of the things that we love, Ryan and I, because we have experience with fix and flips and renovations and what have you, is the ability to increase the value through capex. It's visceral, it's real, and it's just very, 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 very helpful. And then you've got the tax advantage. And when we are presenting a deal-centric webinar, we show a K1, and that K1, for example, on a deal that's near and dear to all of us, the first K1, $100,000 investor got a $60-some thousand depreciation write-off. Now, that's mostly to be applied against other capital appreciation, but it depends. There are ways there where it can be applicable to a guy's W-2 as well. But income, capital appreciation, and tax, and low volatility. You can't forget about low volatility. I mean, everybody knows the word volatility in the last 5 or 10 years in the equity and bond market. So it's kind of like set and forget. Sorry, I'll talk all day about that, Mr. Strong.
I think it's a good point. I mean, multifamily, unless you over leverage it or you pick the wrong debt structure, it's always been traditionally a very safe asset. And I think that the model that Porter's and Iron Ridge has been using is take a traditionally safe asset and try to add some value to it. And to your point, if you increase cash flow, you increase the value of the property. So if you can increase rent by $100, you've increased the value by $20,000. So if you do that math and you say, okay, we buy that 100-unit property instead of a single family home, we increase the rent by $300 a unit. You've increased $60,000 a unit, or $6 million in value, just by increasing that cash flow. Now, maybe it took you 10 grand a unit to get there. So it took you $1 million to create $6 million in value. That's a $5 million delta. And that's how you make money in real estate.
Yeah, when I was, on Wall Street and placing large sums of money in high net worth individuals' accounts, it used to be that we would refer to U.S. Treasuries and AAA insured bonds as a place to put your safe money, and the equity market was a place to put your aggressive money. And I may be wrong, but I think if an operator applies everything that we're outlining in this deck, that this could be likened to safe money. As long as you're aware of the fact that it's not liquid and you're not going to get out before the performer is designed for you to get out, it could be likened to that. So that may be a stretch, but that's how I feel about it, and I'm entitled to my opinion.
It's a good opinion.
So stability over speculation. Does the property pay you today, or do you have to rely on 3-year projections to make the deal work? We already said that we want day one cash flow, and then there it is. So prioritizing durability, optimization versus protection. We don't chase home runs that risk a strikeout. It's just too much work. It's not. It increases the volatility that we said that the asset class doesn't have. So, and consistency. The goal is consistent, tax efficient yield that survives market cycles. And we talked about projected returns before, but they certainly matter, but they're only the result of the structure underneath them. I mean, we really encourage investors to spend less time comparing IRRs and more time understanding the debt, the assumptions, and whether the general partner is truly aligned with the limited partner. I mean, good structure doesn't guarantee success, but poor structure can make success very difficult. So there you go, right there. Structures your insurance policy. Prioritize consistency over optimization. So now we have a case study, and we happen to have somebody with us. Well, we all do, but that really knows a lot about this case study. This is our first deal, Southcrest, and we co-GP'd this with Iron Ridge Capital. So Eric, have at it.
Yeah, sure. I mean, we really liked this deal when we looked at it. It was a project that was located in South Dallas, which I think can get kind of a bad reputation, and deservedly so. But this was in a little bit of an oasis where it was right next to a college. It was a Christian college, and it's protected by a green belt and the campus, and it was a relatively stabilized asset that had proven some value upside, and it just had a lot of things that we liked on it. It had new roofs and new HVAC, and when you're buying a property, you're buying all the systems that come along with it. You're buying the plumbing, the electrical, the roofs. You're buying any kind of deferred maintenance where you might have to sink a lot of money into it. So I think you have to be really careful in terms of how much money you have to put into the property to maintain it. It also had a really low fixed rate debt, so we could assume the financing. It had strong occupancy. And when we purchased this thing, we were able to continue the rent growth and continue renovating units on something that had already been proven, and we were able to start distributing capital early to all the investment partners. So I think the original plan was within 12 to 18 months start distributions, and by month 9 we were sending out cash flow checks, which felt great because that's why we do this. Part of one of those big returns, cash flow, refinance, and sale proceeds, is cash flow, and it's a wonderful thing to get a K1 at the end of the year saying, hey, you received $25,000 and you owe the IRS $60,000 less. And that's why we love real estate. So.
And we love this deal, and it just keeps on proving that we're right. Well, I don't know if you want to follow up with this a little bit. This is the second slide on the same deal.
Sure. Yeah. We had, part of the plan on this one was we had about 55 units that we needed that were still in classic condition. The previous owner had renovated and proven rent upside on, gosh, what would that be? The first 95 units. And, our philosophy is that speed kills. So when we come in, any type of changes that we're going to make, we want to make them very, very, very quickly. And we want to establish ourselves in the market, make great, kind of community events, get the current residents excited to live there and refer friends to us, and get things up and running as quickly as possible. So, our current occupancy is just above 97%. Our delinquency is below 3%. And just to give context, the overall market in DFW, you're kind of anywhere between 87% and 91% occupancy. And, we just take that to that relentless nature and, being strong operators and making sure that, we got boots on the ground and that we're working harder than anyone else around us. Because, all of our investors in these projects, they're our friends, they're our mom, dad, aunt, uncle. And we want to make sure that we've got a comfortable Thanksgiving table to sit around every year.
Yep. All right. Very good. Thank you. And
maybe I'll just take a minute. There's a great question by Jessica in the chat, and so she asked, how are investors kept informed after they invest in these types of investments? And I typed out a kind of a lengthy response there, but I'll just kind of reiterate this for the benefit of the rest of the folks on the call. Typically there's a quarterly update that most operators provide. In some cases, it's a monthly update, and so those updates include, just general understanding, like Eric just mentioned, the number of units that have been updated. There's a gym that was built on this property. There is some improvements to the grounds there in terms of landscaping and so forth. And so you would see generally, those types of updates in terms of the number of units that are done, and then you would expect to see financial performance as to how the asset is performing, and then generally speaking, you're expecting to receive cash on cash returns at some point, ideally within the first year, and so you should receive a fairly comprehensive update on how the asset is performing. The operator may also do kind of a seminar, a webinar like we're doing right now. We've done that with Southcrest for our investors on that, and we'll do that again. And so clear, communication is the sign of a good and honest operator. And as Eric has mentioned, my money's in this deal. Our friends and family's money is in this deal. And so, we definitely want to report out, and not all the news is rosy, right? And there's been some challenges on this deal. There was a situation where the on-site staff had to be cycled out, and new folks cycled in. And so the idea there is that you get the full truth on the deal, and you understand kind of how the asset's performing over time. So I'll stop there.
No, I knew you were gonna like that one, Ryan. Ryan's really always encouraging us to have as many touch points as we possibly can with our clients. And after working in a number of wirehouses and Prudential and Payne Weber, I know that people do get lost in the shuffle. So I feel really strong about the fact that, I mean, we're totally accessible. And we have a newsletter that comes out every month, and it talks about the status of the deals that we're in, et cetera. So, yeah, it's a great question.
Well, just a quick time check. We've got about 20 minutes left, so we might want to just pick up the pace just slightly.
Okay. The discipline of no. We don't chase yield at the expense of safety. We don't rely on 5% plus rent growth assumptions, and we avoid short-term risk debt. This is Mr. Strong, so maybe he can pick up the pace, because he always says we can go over.
I'll try. I'll try to go. I think similar to what I was talking about before is that I think as a limited partner or as an investor in any project that you're looking at, whether it's real estate, venture capital, any private investment, really even any public investment, and Warren Buffett he said it better than I could ever do it. He said, do they have good managers? It's not always the horse. Sometimes it's the jockey. And so whenever we're evaluating any type of investment, any type of deal, real estate, in or out, the first thing we look at is the key people. And from a pyramid going down, there's things that I just hope that every investor looks at. And the first one is just very broad. It's, do I like them? Do I trust them? Do I think that they're going to do their very best with my money? And then you go on to evaluating, what does that very best mean? Do they have the capability to do that? Do they live locally? Do they have, years of experience? Have they seen rough patches in the industry? And, this can be anything. It can be tech, it could be real estate, it could be markets. But you just want to know, okay, well, when things went wrong, how did you behave? Were you protecting the interest of the people that gave you their hard-earned money, or were you looking out for yourself? So I think that the track record is very important. I think the accessibility is very important, similar to what Ryan and Bruce were talking about with communication. I told my wife when we were engaged, I said, outside of the birth of our children and our wedding, if it's an investor or a broker, I'm going to pick up the phone. And I hope that we're on the same page. And she agreed to it. We've had, relative bliss. But I don't think enough emphasis goes on the key people in any operation, and really getting an idea of who you're investing money with is the number one priority. Then I think it's really incumbent upon every investor to understand at least, why am I investing in what I'm investing in? And if it's a new asset class for you, take the time to ask really tough questions and learn about the ins and the outs of real estate. And go ahead and just ask the question. If you don't have any more, hey, what am I forgetting to ask? And a good operator is going to tell you just as much about the risks as they are about the opportunity, because they're going to want you to be aware of the decision that you're making.
Cool. Yeah. So I'm sorry, Ryan. I'm going to. I'd just like to add that in private real estate, you're really making two investments at the same time. It's just a recap of what Eric said. The property and the operator. The operator is the one making decisions that ultimately determine whether the business plan succeeds. So, we spent a year and a half getting to know an operator before investing alongside them. And, because time has a way of revealing character. And in this business, character is just about as important as competence. Okay, so I'm not sure about this one. Okay.
I think that's,
Oh, yeah.
this
This is the good. All right. So, how do you get involved? Your investment journey. You have an initial conversation, and we want to understand your goals and your risk tolerance and your investment objectives. If we put on our fiduciary hat, we want to know really what's in the rest of your portfolio, and then we're going to review underwriting and our business plan and debt structure and projected scenarios for a typical investment that we show out. And then we're going to ask you to attend an investor webinar, so that you can see firsthand what are the ins and outs of the deal and the metrics and the demographics. And then you're going to do your own due diligence and evaluating the operator and their track record. And typically, an operator is going to show all that out on their website or their LinkedIn presence. And if this is all happening on a deal and it's deal centric, then we show out the offering in our CRM cash flow portal, and you're able to go in there and make a preliminary soft commit. And then eventually that converts to a place where we have them all in, and then we change that to investment open. And then, that's when you receive and review and share with your attorney or whatever the case may be and execute on the documents. And then you fund. It's pretty simple in digital and electronic the way we have it set up. We haven't had anybody complain yet about any challenges with knowing exactly what the next step is.
Yeah, I would just chime in and say that, we've invested a lot in our investor portals and the technology that we use to make the process as easy as possible so that you can see things online and sign electronically, and transfer funds in, and that investor portal is available for you to go into to view your existing investments, view new investments, and just kind of track how things are going. And so we've tried to make this process as simple as possible, and we have our partners partially to thank for that. Iron Ridge, along with our investor portal, technology folks that help us along the way.
Yep. What a good question from David too, about tax benefits of depreciation fitting into an overall investment strategy. David, I'm not a CPA, so I do have to give that disclaimer. I will tell you how it works with myself and a lot of my friends. In depreciation, the IRS says that these properties have a 27.5-year shelf life before we've fully depreciated them and they're not worth anything. So typically you have straight line depreciation that you get to take every year. So you take the value of the property and the improvements divided by 27.5. What we will do oftentimes is we will do a cost segregation study. That's how we had that $60,000 tax loss on a $100,000 investment. How it fits into the overall strategy is that you're either going to fall into two buckets. You're going to be a passive investor or an active investor. If you're an active investor, you can typically write that off against all forms of income. If you're a real estate investor, it's uncapped. If you're not specific to real estate, I believe the cap is around 500,000, but you got to check your CPA that you can write off against W-2. If you are a passive investor, you get to write those tax losses off against passive gains. So those are things that, hey, you sold some stock after 3-4 months in the stock market. You do have to pay a 25% depreciation recapture when you do sell, so it's not free money, but it's a very good tool to limit how much taxes you're paying, capture the time value of money, grow that money before you do eventually sell, so that if you were going to owe the IRS $20,000, you can delay that, grow that 20,000 over the next 5-10 years, and then pay them back with money that's appreciated. So I'm not sure if that's answered the question, but it's kind of along the Mitt Romney school of investing, which is buy, borrow, die. And then when you do die, which is the biggest part of my investment plan, my kids get a stepped up basis. And hopefully I've spent about 40, 50 years not participating in taxes.
It's a great summary.
Excellent. Thank you. Yeah, if this framework aligns with how you think, then, capital appreciation, risk management, long-term value creation, then go ahead and take the initiative, join an upcoming investor webinar, review current opportunities, and ask difficult questions about the market, the structure, and the operator. So, yeah, as we conclude, I have one final thought. And I mean, our objective tonight clearly wasn't to promote a particular investment. It was to equip you with a practical framework for making better investment decisions. If tonight helps you become a more informed investor, then we've accomplished exactly what we set out to do. So I thank you for joining Ryan and me in this meeting, and a special thank you to Eric Strom, for sharing your extensive knowledge and perspective. And remember, the best investment decisions are rarely driven by urgency. They are driven by clarity, discipline, and conviction. So I think that's it. I think we're done, unless there's more questions. You guys seem to field them as we went along.
Yeah, there's an additional question in the channel from David, who asked about the tax benefit. And so I think this is probably a good one for Eric Strom. He works in market intelligence, and he's asking effectively, what are the indicators that are telling us right now that multifamily is worth investing in?
That's an incredible question. I think that you're always trying to evaluate what type of market you're in. And in 2022 to 2025, we did not buy anything. And that is supposed to be how we make a living, is by purchasing apartment properties. And it was because the indicators were showing us that the market was too frothy. And we have a saying that you can never write hope into a business plan. And I think that a lot of people were assuming that rates were going to stay low for a very long period of time, and the rents were going to continue to go up. And as long as that chart just kept going up and to the right, everyone was going to be very, very good. I think collectively we have a lot of scar tissue from 2008, 2009, and we know that things don't always continue to go up. So when we saw that the price per unit was going up, people were getting, as an indicator, getting into more risky financing to make deals work. We knew that people were trying to manufacture a deal, and we took a bit of a sidelines because we saw that rents were softening, that vacancy was expanding, and so you look at the fundamentals. So in this market right now, I think that, as we alluded to earlier, we're not in the first inning of the next cycle. This is where an experienced operator, an investor who really knows what they're doing, can make a lot of money. And then what's going to happen in the next, maybe it's 12 months, maybe it's 24, is that the indicators you're going to see is that when vacancy rates start to decline and occupancy is tightening and rents start to go up, then you are in the beginning of that next cycle. At that point, that the wind is, behind you, and at your back, and you can take a couple more, risks, because the market will bail you out, because these real estate cycles, they go gradually, then they go steeply, and then they drop. Every single one I've ever seen. So those are the indicators we're typically looking at. We're looking at tenant credit, and we get a lot of great data on that. We're looking at occupancy. We're looking at delinquency. And then of course interest rates, because debt is a big part of these transactions. So when we see those really starting to tighten, we'll get a little bit more bullish. Right now we're just being very opportunistic.
Yeah, I'll just chime in and say, I posted a Warren Buffett quote in the chat there. Be fearful when others are greedy, and be greedy when others are fearful. And so it goes back to that cyclical, word that we have been using. There's a lot of there's some carnage and some blood, that has been experienced as a result of this frothy market that was out there from this 2020 to 2024 period. And so there are some investors that are losing their equity and so forth. And there are buildings that are being foreclosed on and taken back. And really, those are operators and folks that were buying during this frothy period using variable rate debt. And variable rate debt is not a no and a bad thing in all occasions. It's just when you combine it with other factors that were happening in the marketplace. So the result is right now that valuations are down quite a bit. And, we are seeing this as a great opportunity to get in to the market and purchase buildings selectively, as Eric has said. And so the bases are low. And as the cycle starts to go up, we're expecting to do well. And so, there's a reason why Iron Ridge and Eric Strom did not buy properties during that period. And that's because the market was frothy. The market is not frothy right now. We're somewhere near the bottom, and there are, banks and lenders that own buildings out there are taking back buildings. And it's a very opportunistic time to get in and purchase these assets at prices that are well below what they were 5 years ago.
Yeah. And I think that's one of the things that I've really enjoyed working, with you and your dad, is that, that there's this kind of inflection point where we're somewhere between despair and capitulation. And there is so much pain in the market, and there's so much opportunity if you can be selective, but we're not betting on the come. We are saying, okay, does the property work today at today's interest rates, at today's rents, in a bad market? Can we make this work? And then we look at, okay, well, as rents come back and rates go down, that's icing on the cake. And that's how you don't get into trouble, is that, you're not betting on good news that you're never sure that actually will happen.
Awesome. We're happy to take other questions. We've got about a minute here left. Is there any last questions that anyone wants to fit in?
Where's the bell? We need to ring a bell. It's 8 o'clock.
What
it's not.
percent?
Sure. Okay. Well, I'll say thanks for joining us. Greatly appreciate it.
Thank you, guys.